Here is the slide that's given to you online, and it relates to the problem I'm about to show you as an example. The first thing to do is make sure you read the instructions, because you're supposed to journalize the adjusting entries on August 31st for a 3-month period. That makes a big difference because you have to keep that in mind. The second thing is you look at the other data. The first one says the balance in prepaid insurance is 1 year premium that was paid on June 1st. So if the prepaid insurance is $4,500 and that is 1 year, you need to go ahead, divide by 12. So you've got the $4,500 divided by 12. That tells you 1 month is equal to $375. Since we're doing 3 months, we have $1,125. We need to take it out of prepaid insurance and put it into insurance expense, because the prepaid insurance does not exist for months June, July, and August, and the journal entry is to debit insurance expense and credit prepaid insurance for $1,125. The second part of the problem says an inventory count on August 31st shows 650 of supplies on hand. Well, there's 2,600 listed in the account. If there were 2,600 supplies at the beginning of the period, and there's only 650 now, so that means that there were 1,950 that were used, and the adjusting entry is supplies expense. Supplies expense 1,950 and credit supplies. The key to really understanding this problem is reading the question. Sometimes you're told how many items were expensed or used. So it could have read there were 1,950 of supplies used, at which point you'd have the same exact journal entry. Or they tell you how much was remaining. It's just one of those things. Make sure you pay attention to the wording. Part 3 in your information says annual depreciation rates are buildings 4% and equipment 10%. Residual value is estimated to be 10% of cost. So you've got some things that it's just easier if you go ahead and you put in a chart. So you've got some items, the cost, the residual value, the depreciation base, the depreciation, and then remember we're only doing 3 months of this. So you've got a building that cost $120,000. Residual cost is 10% of that, or $12,000. So your depreciable base is the difference, or $108,000. Your depreciation for buildings 4% of that, so that's $4320. But that's 12 months. We're only going to take 3 out of 12 months, or $1,080. The equipment has the same kind of process. That's got a cost of $16,000, residual of $1,600, depreciation base of $14,400. So depreciation, this time it's 10%. For $1,440, but that's an entire year. We're only going to do 3 months, so it's $360. What you end up doing, it's easy if you make them into separate entries. So you have a depreciation expense on the building of $1,080, and accumulated depreciation of the building $1,080. Yep. And then you have depreciation expense for the equipment of $360, and accumulated depreciation for the equipment of $360. The fourth one is unearned rent revenue of $3,800 was earned prior to August 31st. Well, that's actually very easy because it's listed here as a liability. You want to get rid of the liability because the company no longer owes it. It has actually been earned. So you're just going to go ahead and you're going to debit the unearned for the $3,800, and then you're going to record the rent revenue for $3,800. I can keep going on with number 5. That says salary and wages of $375 were unpaid as of August 31st. And while there's salary and wage expense, there isn't a salary and wage payable, so we need to make sure we record that, or we create that account. In Excel, it's easy to do. You insert a line. So you have salary and wage expense of $375, and then you just create an account, salary and wages payable, for $375. The 6th one is rent of $800 was due from tenants at August 31st. You just need to look at what accounts are there for your company. In this case, they have accounts receivable because this is what they do. This is what their customers owe them. So they're going to now owe them rent of $800, and that becomes rent revenue of $800. And finally, the 7th part is the mortgage note is dated January 1st, 2015. So the mortgage rate is 8% of interest per year. And we know that interest is principal times rate times time, and that we need to keep everything in the same context. So the principal of the mortgage is this $50,000, so that's our principal, times our rate, and our rate is given to us at 8% per year. So our time has to be in years. Well, in years, it's 3/12 of a year. So that comes out to having $1,000 or $1,000 in interest. So the entry is interest expense and interest payable. Next, I posted all the journal entries. You'd post them to the account, but the worksheet makes it show very easily. I could have inserted little lines between the adjusting entry pieces, and that would be right here. And I could have marked them adjusting entry number 1. So, for example, the first one was on the prepaid insurance. So I could have said little number 1 here and a little number 1 here. I didn't do that just because the problem was so simple, but I suggest that people do it when it gets to be a little bit longer. And then you finish the worksheet. I suggest you go ahead and try it. Make sure you at least get this far before you proceed to creating financial statements. Now you take those items, or the amounts from your adjusted trial balance, and the last columns on the worksheet. First, you create your income statement. This isn't the kind of statement we're going to discuss in Chapter 4, but this should still represent what you've done in financial accounting. So you end up with your net income. Carry that down onto your statement of owner's equity. That had a beginning balance. You know that because it said retained earnings 0 on the initial account. Add your net income. Subtract your dividends, and you get an ending balance in owner's equity. That amount carries here as share capital, retained earnings right here on your balance sheet. So when you're finished with that and you've got all your proper double underlines, you know you've gotten that far correct. You might have put something in the wrong account, but you're pretty much 90% assured that you're good. Now you end up with your closing entries. It doesn't matter if you close dividends first, and it really doesn't matter if you use income summary or if you put them right into retained earnings. That's going to be depending on your company. But the idea is simple. First, close one of your income items. So you can close revenues or expenses. It's just easier. We know rent revenue has a credit balance, so we're going to debit it to close it. We're going to credit income summary or retained earnings. We know we have each of these items. They have to be separately listed on our journal entry because they're separately listed in their own accounts. What you end up doing is, we know they have expenses, have debit balances. We need to credit them to close them, and we're going to debit income summary or retained earnings. The third is to close income summary. Well, if there's a credit balance here and a debit balance here, then there remains to be a credit balance. It needs to be debited. It is not a coincidence that this amount is equal to our net income for the year. We close it out by debiting it, put it into retained earnings. If you're already closing into retained earnings, this third step is not necessary. And then the fourth step is to close dividends. Well, dividends by nature are paying back the owners part of the earnings that have been kept in the business. So if retained earnings is a credit balance, dividends offset that as a debit balance. So we credit it to close. Now that that's finished, and this part wasn't part of the problem, I just want to make sure I show you the whole set of steps. We're pretty much through the accounting cycle. You should know from your first course how to journalize transactions, how to post them, how to prepare a trial balance. You should have remembered how to do adjusting journal entries, but this problem was kind of there to help you get through that in case you forgot. We come out with the adjusted trial balance, financial statement preparations, closing entries. We've done that. If you were to go back and do a post-closing trial balance, it would look just like your balance sheet. If there were any reversing entries, we would do that again. And we're back through the entire accounting cycle. Let me know if you have any questions.